I don't know if you've noticed, but the Treasury bill rates have been going down. They have been declining. When you even look at the numbers, it's fallen down from 16.92 in August this year. And the economic reason is because the Central Bank of Kenya is intervening in the Kenyan economy so that more money is flowing, more money is circulating. When you look at the inflation rate, you're also going to notice that the inflation rate for Kenya has been declining. Currently in October, it was 2.72. Actually, look at the one for January, the one which was... So in January this year, inflation was 7.5. It's also been declining from 7.5 in January to 7.26 in Feb to 6.97 in March. Like, it's just been declining till October, where we hit the lowest low, which is 2.72. Inflation measures the rate at which the prices of goods and services in a country increase. So in this case, that measure has gone down. A lower inflation rate means that the demand for goods and services has gone down. More people are not buying products like they used to. People are not buying cars the way they used to. People are not buying houses or property or clothes and shoes like they used to, because the demand for these goods has gone down. One of the most probable reasons is because there is no money supply in the economy. So in this case, they are trying to encourage you as an investor to make alternative investments other than investing in the treasury bills or the treasury bonds, because the returns are lower. Why would you want to invest in a treasury bill when you can actually put your money in a business, when you can buy real estate property, when you can buy land? Let's assume that this money that you are going to invest in a treasury bill, you saw that the rate was so tiny or very little, you decided to take a risk and start a business. And the business does well, and you employ more people, and you pay them salaries, you pay them commissions, you give them bonuses, or you use this money to buy a plot of land, then start building property. You are employing more people. More money is going to transfer from you to their pockets. And if people have more money in their hands, they're going to spend. They're also going to invest. They're also going to buy more goods and services. They're going to buy themselves shoes, clothes. So the whole point of this is to sort of like discourage you from investing in them, because you can make alternative investments that can make you more money. Or instead of investing this money, you can just stay with it. And in such a case, you're going to find yourself spending. And if you spend more money is trickling back to the economy. And the cash flow of money in the economy is also going to increase. This move by the central bank is completely normal. It's normal for all the central banks in the world, because they usually try to see how the economy is performing. Then they try to influence it. If it's underperforming, they trigger it to perform better. In this case, lowering the treasury bill rate so that you can make alternative investments or you can spend more money. Something else that is in line with this is that you're going to notice, if you check the central bank rate, the central bank rate is the rate at which your local bank is going to borrow money from the central bank. So if this rate is lower, it's going to trickle down to you as somebody who's taking a loan from a bank. And that's something that you're going to notice is currently happening. The central bank rate just reduced in October to 12%. Previously, it was 12.75%. Prior to that, it was 13%. So you can see that the Central Bank of Kenya is also trying to reduce the lending rates. It's trying to influence rather the lending rates. Therefore, you as a consumer, as somebody who banks with a bank, taking a loan is also supposed to be cheaper. And what happens if you have more money at your disposal? You spend it. You invest in it. And if you invest in it, more money is in circulation, more money is moving around, and people are going to spend. And if people spend, the demand for goods and services also goes up. Imagine that you bought a Mazda Demio 2018, a 2018 Mazda Demio, and the price of that car is 1.8 million shillings. The cost of importing that car is 1.8 million shillings. I don't know if that's the price. You can let me know in the comments. So this importer notices that these cars are not selling. They're not selling at all. And this importer has to make money. What will happen? The importer will lower the price of that Mazda Demio 2018. I actually researched that. The price. The importer is going to reduce the price from 1.8 million to, let's say, 1.4 million. What happens? The people who have 1.4 million in their bank accounts, they're going to notice that the price has gone down. And since they've been willing, and now they have the ability to buy that car, they're going to buy that car. And if other people notice that the price has gone down and they can afford that 1.4 million, they're also going to buy the car. Now the importer, the car dealer, notices that the car is in high demand. What does he do? He increases the prices to 1.8 million until It's in the same cycle exactly. So that's the same thing that the central bank is trying to do. They're trying to influence the circulation of money in such a case, such that the inflation rate will slightly go up to a healthier level, because this 2.72% that we saw in October is not a good indicator that the economy is doing well, or rather that the money is circulating. As a treasury bill investor, or as somebody who wanted to invest in a treasury bill, do you think that this move is a good move, or is it a bad move, or what do you think? Kindly share your thoughts on the comments. Like this video. See ya.